Hello, everyone, and welcome to another Honey AMA. This is for people that have referred 3 or more people to the Honey newsletter, which you can sign up to in the link below. Reminder, if you have referred 3 people, that you can submit questions at any time, and we will endeavor to answer them in the next AMA. So if you haven't done that yet, then please do so, as it's always fun to answer your questions. And with me today again is Dan Lane, our senior analyst. So thanks, Dan, for joining me.
Thanks very much, David. Good to see you.
Okay, it's going to pull up the first question, which is from our reader Jan. And Jan asks, Ocado, hold or sell? It seems like the company missed its chance to become a genuine alternative to brick and mortar supermarkets during the pandemic, but there remains hope that their B2B service, that's business to business service, could help it raise profits a la Amazon Web Services. So Dan, if Dan is our kind of in-house expert on supermarkets, as anyone who downloads our long report in the first quarter of this year will know. So Dan, I'll hand over that question to you.
Yeah, do you know, like Q1 seems a long time ago now, doesn't it, with our supermarkets report? I guess the first thing to say, Jan, is that we can't give you any specific advice on buying or selling. We're not financial advisors, but we can certainly have a chat about it, though. And Jan does actually raise a good point on Ocado specifically, because if you think about before the pandemic, supermarkets were kind of viewed as this kind of like backward sector, hadn't really budged in a long time. It was the price race to the bottom. If you were the cheapest, you got the most customers. And it was all of this real race to the bottom. That's continued, but Ocado offered something different, specifically in their customer fulfillment centers, which I think investors know them for now. And they were kind of like this tech firm masquerading as a supermarket. And I think that really showed over the pandemic. So it was interesting to see, it was actually over the pandemic that they changed the sector that they're in from supermarkets to tech. So they actually said, guys, we are a tech company. From this actually changes how you might want to view them, because what they're saying is we're not a supermarket anymore. We were genuinely not. Such is the success and focus point of our business that what we want to be doing is selling our fulfillment center tech and these whizzy robots to other supermarkets. And that's actually been a very, very, pre-pandemic actually, it was a very, very strong source of revenue growth for them. So it's shifting it to Canadian companies, the France's Casino Group. And that, the pandemic really stunted that growth. So I would say the B2B area of the business is a much bigger focus point than concentrating on them as a traditional bricks and mortar, shelf stacker supermarket. I would say that recently the share price has come off for a couple of reasons. Investors are now realizing that the market share of Ocado really hasn't shifted in the past few years. I think Kantar World Panel is always good to look at this, and they said, it's recently Ocado has about 1.8% of the market, the whole UK supermarket market. A few years ago, that was 1.4, 1.5, then 1.6, 1.6. It's really not shooting the lights out, though. Everyone thought Ocado was going to just steal market share from everyone. It didn't happen because their focus point was never to become a supermarket. It was these fulfillment centers. Now, share price is off because people are starting to realize that they maybe got a little bit ahead of themselves in terms of the tech. Robots crashing and setting the whole, one of the warehouses on fire probably didn't help. That headline, that really took a few points off the share price. There are a few hurdles to, especially if it goes on fire, offering those out and trying to sell those fulfillment centers gets a little bit more tricky to customers. But, look at the long term. There might still be opportunity in that. Once they get that under control, they're by far and away the most technologically minded of anyone connected to the supermarket chain. So who knows? We're not going to say hold, buy, or sell because I can't see the future. But there's certainly an interesting player to watch in the tech space.
Okay. Hopefully that answers your question, Jan. We'll move on to the next question, which is from Aaron. Aaron asks, index funds have been my entry point into investing after reading personal finance books. How do I bridge the knowledge gap to be able to analyze individual companies to decide if they're right for me to invest in? Are there any books that you could recommend? Dan, do you want to start there?
Yeah, do you know what? I'm going to swing this back to you because I know you have some interesting thoughts on this. But just beforehand, I just think, I mean, it's a great question, by the way. It's a very standard way to enter investing. You might be going into ETFs, for example. So these broad, diversified ETFs, hopefully something, gives you exposure, maybe global, maybe a whole market. It's a cheap way into investing as well, a lot of the time. But a thing to say is that there's no innate need to kind of graduate, as it were, into stocks. I mean, some of the best investors out there will stay in ETFs their whole lives. Buffett says that, if you don't want to get in stocks, index trackers will probably suffice for over the long term. And remember, a lot of active managers fail to beat the benchmark or fail to beat their indices. So there's nothing, you're not like more intelligent or you're not a better investor if you go straight into stocks as opposed to ETFs. I don't know. What are your thoughts, David?
Yeah, I would agree with that. I think there's another point to add is that a lot of the time people, when looking to move to invest in individual companies, think that there's a sort of exact science. And so if you know how to analyze a company and using XYZ methods, then you'll always be able to figure it out and you'll therefore always be able to make money from it. Whereas everyone has their own approach, and things are always uncertain. So you can't basically figure out one method and then think, okay, well that's always going to work. So that's one thing I would say, and I would also add that because people a lot of the time feel as though they haven't figured out that method, they then feel reticent about jumping in and investing in companies. And that's not to say you should just rush into things, but basically, if you think, okay, I've read this, I've studied this, and I think that this is a roughly good method for putting a value on a company, then you kind of then yeah, you shouldn't feel like that should stop you from doing it. I suppose that's one thing to say. But in terms of books, we give out two of the books I would recommend as part of the referral scheme. So one is Investing for Growth by Terry Smith, which is a collection of articles that he's written, but also reports to his people who hold a stake in his fund. And I think that's a really good book. It's quite an easy read. It's not too long, and you get some really good insights into how he looks at companies, values them, chooses what to invest in, chooses what not to invest in. The other book that we give away is The Intelligent Investor by Benjamin Graham. So that's quite an old book. I mean, I think the first one, could be wrong here, was maybe written in the 30s, and he kind of updated it until I think the last edition was maybe 1970. So it's quite an old one. But I think what's interesting about that is you realize that as much as technology and so on has changed, people's behavior hasn't really, and the actual methods of identifying good companies hasn't really. And if you get that book, a lot of it comes, if you get one particular edition, with quite good commentary by Jason Zweig, who's still around, still writing. And I think those two together really, it's quite a long read. It's about 500 pages, but it's worth it because it's got some really good insights. And then a couple of others I've mentioned. One is kind of a classic one, which is One Up on Wall Street by Peter Lynch. Again, that's not a very difficult read. Couple hundred, maybe 300 pages, but very easy to get through. And it has some good tips on valuations, how to find companies, all those sorts of things. What advantages you have as an individual versus fund managers. So those are good. And then maybe the last one, I wouldn't necessarily say this is good for investing in individual stocks, but I think a lot of time people feel uncomfortable about investing because they feel that it's somehow tied to economics, and perhaps they aren't familiar with just sort of rudimentary stuff in economics. So there's a book called Basic Economics by Thomas Sowell, I could have got the title wrong there, something like that, something like basic economics. And I think that's, again, it's quite an easy read and a very good introduction to all this sort of how markets work and how bonds work and all this sort of stuff. So if you're feeling uncomfortable, it's not necessarily going to be good at helping you to say, okay, buy company X, but it's good at sort of easing you into how the economy works. One thing, and then another thing I add is just like, if you're fund managers, it could be as obvious as Warren Buffett and so on. They write quite a lot in sort of individual articles or reports to shareholders. I mean, Warren Buffett's annual kind of Q&A thing he does with investors. I don't know how much longer that will go on, given he's 90, but it's worth a watch. So those sorts of things that maybe aren't as obvious as just a book, they're also a lot of the time quite useful. So hopefully that helps.
I would say a couple of things. I think Investing for Growth, super book that you mentioned there by Terry Smith. And you're absolutely right. Terry Smith gives an AGM every year. All of them are filmed, all of them are on YouTube. And he goes through so clearly the methods that he uses to pick stocks, why he chooses them. He couldn't make it clearer in my mind. He's one of the clearest orators of investment processes. So I definitely recommend watching those and reading the book. Obviously, you just need to refer people and we'll give you the book for free. But a last point on that I would say is there's a good middle ground between active management and running some index funds as well. A core and satellite approach can be really useful. So if you think about like a daisy, the central yellow part might be the biggest element of your portfolio, and that might be a broad-based market ETF. And then the petals around the outside might be some smaller high conviction stocks that you choose. You can talk about Peter Lynch's methods of looking at the PEG, the PE divided by the growth rate, or you might go into Terry Smith, who is willing to pay up for growth. You might go into value investing, where price to book and price to sales comes in. There's so many ways that you can get involved in that. But why not begin by having, managing your risk by having that broad-based ETF in the middle with a few high conviction stocks around the outside. If they go well, that'll be great. If they don't, it's not going to destroy your portfolio. Sometimes it's a nice way in.
Yeah, I would agree with that. Okay, we can move on to the next question, which is from Chris. Chris says, I'm curious to hear the team's thoughts on SPACs and where we go from here. Are all SPACs bad? Are there any legit use cases? What happens to the wider market when all these SPACs don't find a target and need to de-SPAC? Or is there going to be some crazy buying frenzy as everyone looks to make a deal? Something I've also really struggled to wrap my head around is the valuation mechanics of a SPAC once a target is found. Things get even murkier when you start to factor in the pipe. This is not a particularly straightforward transaction. How are sponsors incentivized to act in the best interest of their shareholders? Any thoughts, Sam, initially?
I mean, listen, I think Chris is expressing what a lot of investors have been kind of scratching their heads over the past couple of years as SPACs have really taken off. For anyone who doesn't know, we're talking about these kind of cash shells that spring up, list themselves on the market, get money from investors, and then go out and look for a takeover opportunity in the private markets, often to effect a kind of reverse takeover to bring that private company to becoming a public company. There's a few things that I've been kind of wondering. A couple of things just about, the way that a SPAC lists and then people are investing in it. It is strange to me that what are you actually buying? Because it's a cash shell. So you're putting your money in there and there's no asset yet. So to me, that says that you're probably buying that, into that management capability and probably not much else. You're kind of hoping that they have something up their sleeve or that they have a deal in mind. But over the past couple of years, we've seen enough SPACs come to market and sit there motionless for a long, long time to realize that a lot of them don't have ideas in mind. And that's whenever they go out and start looking. So my money is sitting there in that shell and not really getting put to work, but the value is getting pushed up and down by other people in the markets. It's made me quite uneasy. I mean, listen, you've schooled up on SPACs recently. What's your take on Chris's asked us an enormous amount of questions there. What can you clear up for him?
So I mean, I would actually kind of agree with what was implied in the question itself. about the transactions being pretty murky and how they work. So I think a couple of things that maybe people aren't aware of when they invest in them. There's a sort of perception that you're buying a share in a company that's a cash shell, and there's just these shares, and once the transaction takes place, the cash is exchanged and the companies merge. But there's two things I think people probably need to be aware of. One is that the companies or institutional investors that buy into a SPAC at the beginning, they usually get a share worth $10, but they also get a warrant. So a warrant is kind of like a call option in a company. Essentially, it gives you the right, or not the obligation, to buy another share in that company. And usually those are priced at $11.50. So if imagine the price of the share is $20, it would make sense for you to buy it at $11.50. So these initial investors can basically they buy these two things together. So for every share they get a warrant, but they can also separate them. So they can keep the warrant and sell off the share. But what usually happens is part of the SPAC process is that once a deal is identified, shareholders have to approve it, but they can also go and redeem the share they have and get the money they paid for it back. And that's the case even if they say that they want the deal to happen. So even if you approve the deal, you can still redeem the share. But because the warrant is separate, it means that it's almost like free money for a lot of these companies. So what they'll do is they'll buy the share, they'll either sell it off perhaps in the market, or when the deal is announced, they'll just redeem it. So they get the money they put down back. And then they have the warrant, which they can either exercise or just sell off as well. So essentially there's something called the SPAC mafia, which is a lot of hedge funds who've invested huge amounts of money in SPACs, and nearly all do this process. So they tend to redeem something like 98, 99% of the time. And it's been kind of like free money for them. I think that someone calculated the returns and it was like 11% per year for them. The thing is that doesn't really work well for, if you think about long-term investing. If someone told me about a group of people doing that and then said, oh, but would you want to buy the shares in the company that they're doing this to? I would probably say no, personally, because it's kind of quite an odd thing to be doing. Doesn't suggest they have faith in the project for the long term. It's just sort of arbitraging the system that's in place. So that's one element. And then something else that Chris brought up is PIPE, or PIPE, which stands for private investment in public equity. And so what that means is, as I just said, a lot of the time, the investors who bought the SPAC at the beginning will redeem all their shares. So if you imagine a SPAC has raised, let's say, $100 million, and then a huge proportion a lot of the time of those initial investors will redeem their shares once the deal is announced or complete or whatever. So let's say, and this happens a lot, sometimes it's 50, 60, 70%. So 100 million is raised, but 50 million, let's say, if it's 50%, is taken back by people redeeming their shares. But obviously, in order to complete a deal worth 100 million, you need to have 100 million. So what the SPAC will then do is go to private equity companies and have to raise additional money from them to complete the deal. Again, I don't know, it's hard to say a lot of the time how that will impact you as an investor, but again, it's sort of an odd process, and one that I think people might not be aware of. And again, the fact that so many people are redeeming doesn't necessarily bode well for you as an individual investor. Of course, another part of this is the fact that warrants, if everyone exercises them, create new shares. And if there's lots of new shares, it means that the value of the existing shares also goes down. So I think one of the questions Chris asked was about incentives. And I think the problem at the moment is that a lot of the incentives are not aligned with those of investors. So if you're a sponsor is effectively the person who goes about raising the money. And another part of the process is they get 20% of the shares, or the value of the shares, as kind of compensation for helping raise the money, complete the deal, and so on. And that's, again, almost like free money for them, and they're kind of free to do what they want with those shares afterwards. So none of those things are necessarily great for you as a regular investor. And if you look at the returns on SPACs, they've been quite poor in general, mainly because a lot of the companies that are raising money this way are pretty speculative. So they're very early stage. I mean, like, we spoke a month or so ago to a company called Lilium, and their idea is amazing, fantastic. You look at it and it just sounds really cool, but it is very early stages. They've got some competition, so it's very hard to say, okay, this company is going to do really well. So I think that's part of the reason there's been poor returns. I think the median return from 2015 to 2020 was something like a 30% loss. So there's a lot to be careful of there. I think if you looked at Bill Ackman, who's kind of a big investor, who's also started a SPAC, he tried to complete a deal recently, and it seemed incredibly convoluted to the point that it was a struggle. Even we were looking at the slides trying to figure out exactly what the hell a deal actually meant. But I think some of the processes he put in place were actually quite positive, because they sent that, for instance, it stopped this kind of arbitraging of buying stocks, redeeming them, and then selling the warrants. He didn't take a 20% fee, and he put a lot of his own money into it as well. So all of those things meant that his incentives were aligned, I think, more with the investors than would otherwise be the case. And the fact that he didn't really allow the warrants to be exercised in the same way or sold off in the same way stopped a lot of that short-sightedness or short-termness, just people trying to game the legal framework in which SPACs exist to try and make some money quickly. Unfortunately, it doesn't seem like there's a lot of other SPACs that are trying to do similar things. So basically, I think my message would be to Chris, like, you were correct in saying that a lot of the stuff that's going on there is quite murky and opaque, and it's quite hard to figure out what is going on a lot of the time. So leaving aside the fact that most of the companies that are listing via SPAC, not all of them, but a lot of them are very early stage, it's sort of companies that would usually get private equity funding. So that makes them almost inherently quite speculative. But when you combine that with the sort of different dynamics that the SPAC legal framework creates, it's all, as you say, a bit murky, a bit strange. And so I think anyone looking to invest should be pretty careful about putting their money into them, and just figure out what are the dynamics at play. Is someone just using this to make a quick buck, or is it a good long-term investment? And I know that was quite a long answer, but I think
it was a long question. It deserved a long answer.
Yeah. So hopefully that was easy to follow, Chris. I understand there was a bit of technical language, but if there was anything that was unclear, next AMA you can ask again. So I think we've probably done enough there. I can move on to the next question, which is from Ian, who says, UK takeovers. Why are loads of UK companies being bought out? Is it a good or bad thing? I can't work it out. So,
listen, it's a fair question at the moment. There's barely a week goes by that we don't hear about some sort of bid coming in for a UK company. Listen, it's not a new thing. It's been happening for a little while, but there seems to be a few more not happening now. Basically, listen, look at the UK market. It's full of kind of, backward-looking industries, mining, banking, some of especially the financial industry, but you've got big firms there that dominate the FTSE, like Vodafone, not exactly a forward-looking firm. And a lot of this, whenever you've got the past year in which the tech high flyers have been everybody's flavor of the month, the UK market has looked a little bit, musty and old. And all of that means that, the buying frenzy in the US has meant that the US market on the whole is trading at around 22 times forward price to earnings ratio. So 22 times, value investors would struggle to pay anything over 10. 22 will be expensive to some people. The UK is sitting at about 12. So there is a big difference there. And whenever, listen, 12, it might sound cheap, but cheap doesn't necessarily guarantee the value of anything in there. It just says that the valuations are low. But the fact that valuations are low are attracting a lot of buyers. So we're seeing, UK pubs getting a lot of attention from foreign people looking to buy into the pub sector. UK gaming, especially the small caps, a lot of small gaming companies have looked attractive on valuation levels. UK supermarkets, Morrison's has got a big bid going on. Sainsbury's has had someone, I think it's a famous Czech investor, kind of hanging around for a little while. Wouldn't be surprised if a bid came in there. Defense firms as well. We've seen a few things. Ultra Electronics received a bid from Cobham, for example, just recently. But basically, what you find is that competitors are thinking, can we buy out the competition cheaply? And private equity funds are thinking, can we buy out these things and basically clean them up, make them a little bit more efficient, and make a lot more money out of them? So there are people who will say that it's not nice to have British companies bought out by foreign companies, and this is blighty, and we need to keep the British and stuff. The reality is that the FTSE is a very, very international market anyway. 75% of the FTSE 100's earnings come from abroad. In the FTSE 250, 50%, or nearly even 60% of the earnings from the whole index come from abroad. It's a very international facing market. What a lot of these foreign investors are thinking that, well, if I can snap up the competition cheaply, integrate them into my business very, very cheaply, find synergies, and still have a UK base with a path into Europe or a path internationally, it's quite an attractive prospect. So I wouldn't say this is the end of it. As long as the UK market stays cheap, there will always be vultures hanging over them, which isn't necessarily a bad thing a lot of the time. Private equity sometimes gives it a bad name by buying a company, loading it up with debt, and putting it back on the market. That's not a great use of shareholder value there. But I would say it's probably going to continue as long as the UK market looks so cheap.
Yeah, I think you're right. I maybe differ a bit. I think that in some cases, perhaps the government should do more to intervene. If you look at the Cobham acquisition, I think it's of Ultra Electronics. Maybe I'm getting mixed up. It's Meggitt. I can't remember which one. Either way, Cobham was itself acquired by a private equity firm before, who made all these promises about not asset stripping or breaking up or losing UK jobs. And then kind of did all of that stuff anyway. So there's kind of a pattern of behavior, and I think that in some cases it's it's not such a big deal if you have a foreign owner, but then in other cases, if you look at stuff like defense or arm, the UK should, I think, aspire to have some areas where it's kind of a world leader. And not be beholden completely to either China or the US, but it doesn't really seem like anyone in the government shares my views. Anyway, maybe we can move on to the last question, which is, I have an ISA with free trade, but can't work out whether I should cancel it and switch to a GIA, general investment account. What's the difference between them, and which account is right for me? Sabrina asked that question. So thank you, Sabrina. Dan?
Yeah, listen, really good question. It's nice to get these questions away from the markets on specific investment accounts as well. What I would say is, listen, start with what are your investing goals? What we would say is it's good practice to always have at least 5 years of a time horizon before you start thinking about assets to invest in. So if you're thinking about 5, 10, 15 years, maybe think about, okay, well, what if those assets grow, especially if you're adding to them? What happens if they grow? Now, if they grow and your assets are in a GIA, a general investment account, they could be liable for capital gains tax if you make over £12,500 in investment gains. In an ISA, it's a tax efficient account. So whatever gains you make, you get to keep. So a lot of people think about, okay, well, I'll just invest in the GIA and I'll cream off every year the amount that would keep me up under the capital gains allowance. That really puzzles me, because why would you not just expose your money to an account that is telling you that it's tax efficient, that you'll be able to keep any gains that you make over the long term, and you just don't really have to worry about it. There's a reason that the government offers us the £20,000 current allowance in an ISA, and that's to encourage kind of good savings habits, and letting us keep our gains is one way of incentivizing us to take care of our own financial futures. What I would say is the last thing that you'd want to be doing is 20 years down the line, looking at your account and realizing that you could have saved an absolute heap in capital gains tax if you had just used a different account. Because realistically, you don't know what the investment performance of your assets is going to look like. So you may as well prep for it now. So there's loads of information on the website. I mean, I'm not going to say that everyone should do the same thing. Obviously, we can suggest certain things and give a little bit of guidance, but it's up to everyone in particular.
So what I usually say, because this is something that genuinely crops up all the time, is that for anyone investing for a long period of time, so that's like 5-10 years, which I think is probably most people, using free trade watching this, it's just much less of a headache to use an ISA. That's not to say a GIA is like complete, you shouldn't use one, but it's just much less stress to use an ISA than it is to use a GIA. So hopefully that answers your question, Sabrina. Thank you for answering. Dan, is there anything else you wanted to add to that one?
No, I think you're absolutely right. For me, genuinely, it's just about that headache. I never really want to get to the end of the tax year and think about chopping off my gains and penalizing myself just to, not have to fill in a tax bill. It's just not really what I've been doing. And, £20,000 is a decent allowance in an ISA. Obviously, if you've filled up your ISA and you don't want to invest in your SIP, a GIA can be really useful. But until you get there, an ISA can be just as useful in the beginning.
Yeah. Yeah, great. Well, that's actually our last question. So thanks for everyone who submitted them. Again, if you have reached through referrals on Honey, please do send over any questions you have. We'll be happy to answer them. And there are quite a lot of you. So some of you have not, well, a lot of you haven't submitted them. So please do submit them. And we'll be happy to do this again very soon. And a reminder, if you're watching this or listening to this and you haven't subscribed to Honey, then you can do that at freetrade.io/honey. We'll put the link in the description to this video, or perhaps audio recording. And thanks again, everyone, for asking your questions. And thanks, Dan, for helping.
Thanks, David.
All right. Bye, everyone, and have a nice day.